Hey folks, it's Dave Burrows. I am here in Calgary today. I'm here meeting with some families that we work with in Alberta. Come out here 4 or 5 times a year, and always enjoy, meeting different people and hearing their perspectives on what's going on in Canada and what's going on in the energy world. Anyway, interesting couple of days. Boy, it has been a week already, and it's Tuesday. Frankly, the last 2 weeks feel like a month. Um, Markets really turned down in February, and we started seeing deterioration in breadth, driven by, some of the loud noises coming out from south of the border. Then when the Trump administration announced tariffs, it had an immediate impact on markets. And in many ways, it's made the world a much more unpredictable place. Markets hate uncertainty. And the truth is, we have to deal with the market we're given, and we've got to use our processes and our systems to make decisions, be unemotional about it. And frankly, really important just to move step by step because there is no one binary answer. I think that there's a considerably large range of outcomes. As Stanley Druckenmiller said at a meeting I was at last week, it's almost as though all of the norms that we have come to accept since the Second World War have been thrown in the air, and we will see where they come down. Now, whether it's bluster or whether it's negotiating or whether it is in all seriousness, I'm not sure anybody knows what the outcome is going to be of these tariffs and how far things can escalate. China, sent back a rebuff to Trump's threats yesterday. And, all we can do is factor odds and try to make sure that we're balancing risks and make sure that we have optionality for when the time comes that things change. So let's just dive in right off the top and talk markets. From a really big picture, we've been in a bull market since 2013. And during that period, we've remained above this rising 200-week moving average, which is where we are today. The month has been a difficult one for the S&P. This was a snap from a little earlier today, probably down sort of 10 or 10.5% on the month now for the month of April. But this is a factor of what's going on, in the world. Lots of economic uncertainty, lots of policy uncertainty. We talked about this in the Sunday video that we thought was a good idea to send out on behalf of the investment team to folks that were at home worrying about what might happen at the beginning of the week. And it was quite a day. So this is the S&P daily chart. And when we work forward from sort of the middle of February, along the way, market made a series of lower lows, lower highs. We broke the 50-day moving average. We broke the 200-day moving average. We rallied up underneath it and failed and gapped lower sharply last week. Yesterday morning, we opened very close to this long-term trend line that's been in place since 2022. It was an 8% range yesterday from where the market opened, where it traded down to, where it traded up to, and then eventually, back to basically flat. This morning was no different. We came in, the market was up about 3%. Lots of folks thought maybe this was a chance to buy the dip. As we said on the weekend, it's going to take some time to work through the uncertainties that have been thrown into the market. One tweet or one piece of news is unlikely to repair all of the psychological damage that's been done over the last few weeks. I feel sorry for the folks that came in guns blazing today because by the end of the day, we were pretty darn close back to the lows. When I look at the weekly chart, this is the trend line that's been in place since the October low in 22. We closed basically on top of it today. Our breadth models that we use, where we track the percent of stocks in uptrend, started to deteriorate back here early February. And, I think about our activity, which has been much higher than normal. We've been carving out positions almost daily since then to sit with where we are right now. I think it's really important in a market like this not to have FOMO. not to think, well, what deals can we have today? There's a lot of things that can transpire, and our job is to be balanced. At the end of the day, we are not going to pick the low in the market, and we're not going to have to, because rarely does the market make a low and reverse and head straight higher, especially when you've thrown as many uncertainties into the mix as has been done recently. We hear about the objectives that the administration has. There's discussion about the fact that, if they can slow the economy down, then bond yields will move lower and will enable them to refinance the $7 trillion that comes due this year and maybe knock down inflation. And in the process, they want to fix the trade deficits. It's kind of like you put the patient on the table and try and do brain surgery, a heart transplant, a hip replacement, and bunion surgery all at once. What can go wrong? Markets don't like this kind of uncertainty. So the tariffs themselves are one thing. There are factors and structural changes that have been taking place in the market over the last 6 or 7 months that I think are exacerbating things. I always say one piece of news doesn't change the nature of the market. It takes a combination of things, a cumulative effect of changes to create instability and volatility. When we look at the NASDAQ 100, this is the QQQ, it's come down sharply, down sort of 23, 24% from the highs. This is not looking that great. We look at the chart going back to the beginning of the bull market that we began in October of 22. We very clearly have sliced right through the uptrend. We sliced all the way through the 50-day, the 200-day. You can see the short-term moving averages have rolled over. The 50-day is rolled over. It's just crossing. It's getting close to crossing the 200-day, and this is the 200-week moving average. So some damage has been done. Now, we don't look at the market as a homogeneous thing. There's different parts of the market. Early on, the things that are most vulnerable get hurt first. And we're always stress testing the portfolios to say, do the sectors we're focused in remain as market leadership? We're always watching for change, new leadership to emerge or old leadership to recede. And in the absence of leadership, this is the most important thing, being prepared to play defense. You can go out and build a portfolio of ETFs and be passive. And if you truly do have patience and truly are happy to live with, what can be 30 and 40% drawdowns, that's fine. I don't think that our clients are in that camp. And they're paying us a fee to do something when things change. And so there is change taking place. When I look at the percent of stocks in the US market that are in clearly defined uptrends, this has been weakening now for, a couple of months. So as we sit today, 18% of stocks, of all US stocks, are in uptrends. As the storm takes place in the market, as the wind gets higher, it takes out stronger and stronger stocks. And, you have to go back to 2020 during COVID to have seen breadth got worse. And it can get worse. It can get down here and stay here. I think about going back to, 2007 or 8 or 2000. And I'm not saying that we're in that scenario, but, breadth can weaken and stay weak. So we have to watch. When breadth is weakening, we don't put on new positions. We wait. We raise some cash. We make sure our stops are in. In fact, we tighten them. We have less tolerance for risk. And we work at building a farm team. So what is on the farm team? These are companies that fundamentally are sound, where we can see in the numbers things are getting better or accelerating, where technically they're holding up better than the market. And it's tough in a sloppy market, but the market is a great stress test, and it gives us an opportunity to build for when the time comes to put money back to work. And it can happen quickly. It generally takes a little bit of time. As we sit today, there's not much in our indicators that would tell us it's time to put money to work. Our long-term indicators, the percent of stocks and uptrends have been weakening around the world. Percent of stocks trading above their 50-day or shorter term trend indicator, broadly negative. All of the short-term indicators we heard. Percent of stocks above the 50-day is sitting at 8%. So 8% of stocks trading above their 50-day moving average. Again, you've got to go back to 2022 in that sell-off to have been at this point. You can see in 2022 when it reversed higher, then it pulled back, and then it rallied, and then it pulled back. That's a bottoming process. That's what took place sort of between September and October of that year. That is what is most often the case. When we look at the percent of stocks above the 150-day or long-term moving averages, again, we're down here at 14%. When we go back to 2020, and we came down through the summer, we rallied, we came back and tested in the fall. So bottoming tends to be a process. And the good news is that when markets retest, very often in the second test, more stocks hold in well. So when we look at the sector work, you can see there's a lot of sectors in small letters, which means breadth is deteriorating. We're stacked up on the left-hand side. It can get further stacked to the left-hand side, meaning a very small percentage of stocks and uptrends. The ones in green have positive relative strength versus the market. In other words, they're the strong men. It includes banks and insurance and precious metals and pipelines. Well, that's good that that's the case. These are, sectors that we have been focused in, but certainly it's not perfect. When I look at volatility, volatility is clearly out of the typical range for a cyclical bull market. Now, bad news is volatility is high. Now, the good news is, we're getting to the sort of spikes that mark near-term bottoms. So is that going to be tomorrow? Is that going to be 3 weeks from now? I think nobody knows the answer to that because we're not in control of the news flow. And as these things are taking place, it's opening up additional risks. Clearly tariffs raise the risk of recession. Clearly tariffs raise the risk of a trade war and geopolitical unrest. And it moves money. Money goes to where it's treated the best. So it's fair to say global investors have been highly focused in the US market over the last number of years, a strong currency and a strong market relative to the rest of the world. US dollar is weakening and policy not so friendly to foreign investors. Now, when people say, well, when the VIX gets to a high level, if you go out any period of time, and historically the numbers are great, and they are. However, a lot can happen between now and 1 year from now. And so I think these kinds of numbers sometimes can lull a sense of false security because, if you look at, 2008, yeah, October of 2008, 12 months out, markets were higher. But between October of 2008 and March, markets sold off 35%. And I'm not sure our clients are fit mentally to go through that kind of decline. So things we highlighted on the weekend, there has been some very significant price moves, 8% for the market in a range yesterday. That's an extreme. High volatility doesn't happen in a healthy market. When markets are not well bid and there's a lot of sellers, price can move a long way. We like to see markets where there's a bid right under the surface all the way along. Now, high volatility tends to happen again as markets are getting closer to making a near-term low. So we watch that. We looked at this ratio on Sunday night, the put-call ratio, the amount of puts that have been bought, which are people buying insurance or trying to buy the right to sell their stocks at a certain price if things get worse. On Friday, it got to 1.6. This got higher on Monday. The amount of people buying inverse ETFs go up when the market goes down. a lot of people trying to create some protection. And the percent of stocks making a low for the last 20 days. And as of Sunday, it was at 77%. It got over 80 yesterday. And we'll see where it was today. But you have to go back again to 2022 market lows where 86% of companies made a 20-day low. Now, I was explaining on the weekend that very often when markets make their initial low, everything's getting creamed. Last week, I think you get to a point where investors who haven't done enough need to sell whatever they have, not what they want to sell. And they sell the things that haven't gone down. So financials, which have been remarkable over the last 2 years, did get hit on Thursday and Friday of last week. So when the market makes its initial low, almost everything is getting hurt. And what you often see is when the market retests the low a couple of weeks later, fewer stocks will make a 20-day low. And again, that gives us clues as to what is strong and what is not. The things that make a new low are probably part of the weak part of the market. In 2008, in December, the market made a significant low. In 2009, the market made another low, but far fewer stocks went back to their lows. It was the financials in particular, and they were the problem. So, we look at these things. In 1998, there was a currency crisis, and long-term capital was a hedge fund run by Nobel laureates. They thought they had a formula that they could beat the market. And when the market made its initial low, 74% of companies made a 20-day low, market bounced, and then retested the low. More than 50% of the time, when the market has a steep sell-off, it will, after an initial bounce, because things get oversold, will sell off again. And if it holds the second low, again, very often, fewer stocks have gone back to lows. That's the type of thing that we're watching for. Now, we haven't even really had a big rally yet. And there will be a day or two or three where we will get a significant rally. And people say, well, wait, now you're sitting with a bunch of cash. The fact is, it can V-bottom, but most often it doesn't. 2011 was very similar. A whole series of tests of the lows over the course of a couple of months. Now, my guess is, given all of the things that are happening in the US, it's unlikely we'll wake up tomorrow morning and Donald Trump is going to say, I've changed my mind. We're going back to where we were before. It's just not likely. So realistically, we're going to have to deal with some news flow. Now, we can't go completely to cash because when markets do turn, they can turn with some vengeance. And we got a lot of great companies and companies that are holding up really nicely. But we have fewer than we did 3 weeks ago. Okay, so we know that US stocks have been remarkable versus global equities. We've talked about that. We've talked about the fact that different than US stocks, global stocks only recently came out of a very long bear market. Japan is a great example. I think we may be setting up for the first great opportunity, frankly, to add global stocks to portfolios. For those that don't have them, this pullback will create an opportunity. The Nikkei pulled back, had a 6% rally last night. We've held at the moving average. We'll see. It's going to take some time. India's pulled back. These are monthly bars. This is the pullback in February. This is the rally in March. Pullback in April. It's way outperforming the rest of the world. The Eurozone also just came out of a bear market. And the characteristics of the European markets are quite interesting. Even China, and China's obviously got its hands full with the US, but it's only recently come out of a bear market, and we'll see what happens going forward. But lots of global markets are in uptrends. That's the Argentinian market. And the TSX is not really very different. In fact, at 2 o'clock this afternoon, the TSX is 9.7% off the highs, where the S&P, close to 20, and NASDAQ more than that. So we looked at these a few weeks ago. Really, these are from 2 weeks ago. The numbers are smaller, but the outperformance continues. The month of March had very significant flows into global stocks and out of US stocks. And this has not changed. After many years of outperformance, You know, the US market is underperforming the rest of the world by more than any time since 1988. And part of that, and I put this chart up before, is because there's so little technology. Now, technology's weakness is not because of tariffs. Technology's been underperforming now since June of this year. And economic activity in Europe actually has been stronger than in the US. This is the TSX relative, or the Canadian stock market relative to the equally weighted S&P to today. These are all months. TSX is still outperforming. And valuations are cheap for global stocks, and the makeup of the indices are more friendly to the things that have been doing better. This is the MSCI All World ex-US Index, made up of 895 global developed market companies. These are the last 6 months. Even with tariffs, it is steadily now outperforming. Now, this is a change. You have to go all the way back to 2010 to see this taking place. So this started months and months ago, and even the advent of tariffs has not reversed it. So let's go to fixed income for a moment. Generational low for rates in 2020. I think this is a really important place to stop. The express purpose of some of the things that are being done, cutting spending in the US government, trying to garner revenues from tariffs, have been done to try and bring the yields down on US Treasury bonds to make it cheaper to refinance the debt. It is not happening. This is a bullish chart, meaning yields look as though they are going higher. And a lot of discussion, we talked about this now for the last few weeks, but a lot of discussion in the last 2 days. Why is it that all these things are happening and the price of a US Treasury bond is falling? Well, it may be that Chinese investors or the Chinese central bank would prefer to sell Treasury bonds and buy gold. It wouldn't be a stretch. It may be that because yields are higher now in Europe than they are in the US, and the currency is appreciating, it may be that Europeans are buying their own bonds. It may be lots of reasons, but the fact is, this is not accomplishing what Trump is trying to get done. Yield curves are steepening everywhere in the world. The difference between a 2-year bond and a 10-year bond is expanding. Now, part of that, I think, is the market is building in an expectation that inflation is going to remain in the system, that inflation is going to be higher for longer. We talked about this over the last few months. After an initial wave in inflation, you tend to have a second wave. And certainly the tariffs are not going to be disinflationary. Gold isn't telling you that. Gold continues to look very solid, and it's relatively early in a bull market compared to the previous 2 bull markets that went on a long time. Frankly, I don't think that China is mistaken in saying they'd rather own gold than fixed income in a world where there's going to be inflation. One of the surprise moves could be that the Chinese devalue their currency to make them more competitive to offset tariffs. So having gold in the portfolio, I think, is really, really important right now. Gold relative to the QQQ, again, to today, after 2000, from 2011 to 2022, tech clearly outperformed. We went through a bottoming process, and gold is clearly outperforming the QQQ now. Gold does well in an inflationary environment. High multiple stocks don't. And last time this happened was 2000 and 2001, and it went on for a decade. This is not, I don't think, a 1-month wonder. Last month was the first month where there have been significant flows into gold by retail investors. Gold versus the aggregate bond index, an inflation asset versus a disinflationary asset, is sending a very clear message. Commodities relative to the equally weighted S&P, again, sending a very clear message. Commodities are an inflationary asset. Gold versus utilities. People go to utilities when they want defense if they think there's a disinflationary world. Gold is clearly outperforming utilities, and utilities up until recently were outperforming the US market over the last couple of months. Our comment was that was likely people looking for a defensive position. If the market gets bad enough, they would get hit too. And they've had a terrible 2 weeks. So the US dollar, I think, is a linchpin. When the US dollar is weakening, generally global markets do better. This is not an unusual thing to take place in the last Trump administration. US dollar was weakening. I think it's really interesting with all the stuff going on in Canada, the questions around the politics and the tariffs. Canadian dollar made a low when the tariffs were announced, and it's actually been climbing fairly steadily since then. And the low was at the same point that we saw in the crisis in COVID in March of 2020, and when commodities cratered in 2015. Right? So again, Canada's a more of an inflationary market with our energy, materials, and financials. So look at the other currencies, Japanese yen versus US dollar. It's made the same kind of reversal that we've seen in gold versus Qs. So what is it that's important at the sector level? The sectors that are performing well are sectors that are more inflationary. And I'm not going to spend a lot of time talking about individual positions today. I think it's a big picture day, but the XLF only recently came out of a long bear market. And yeah, it's pulled back a little bit, but on a relative basis, relative strength continues to improve versus the stock market. Eurozone financials are the same. On the other side, this is the linchpin, I think, for the weak case. What everybody owns. Everybody owns large cap tech. This is the XLK ETF made up of the biggest of the big technology companies. Relative strength started to weaken in June of last year, way before we thought Trump was getting elected, way before we knew about tariffs. I think the market was telling you that inflation and rates are the problem. When the Fed cut rates in September, for the first time in 45 years, bond yields went up, not down. That was the market saying, oh boy, we think that you're cutting rates and there's going to be inflation. We're going to have a problem. The Fed now has a real problem because tariffs are going to be inflationary. And it's highly likely that the US economy is going to slow. And so on one hand, they've got a mandate that says our job is to have the US at full employment. On the other hand, they've got a mandate to keep inflation low. So this is the first major market challenge that I can think of, going all the way back to before the financial crisis, before the tech wreck in 2000, or the financial crisis, or the Asian currency crisis in 2015, or the 2018 tightening sell-off, or the COVID low, where the central bank is not ready to step in and support the market. They made it very clear last week. They said they're going to look backwards until they see hard data that says inflation is staying low or that we are starting to see unemployment pick up. Frankly, I think that will be too late. But the market took that as a message to say, don't expect the Fed to be the backstop. So there's the XLK down 25% off the highs. It did break the 200-day moving average for the first time in 500 days. That's a good measure of trend. Global stocks are the same. The Mag 7, 7 big tech stocks, broke all of the moving averages, and now the 50-day is about to cross through the 200-day, and relative strength is doing nothing but weakening. Had a nice bounce yesterday intraday and a sell-off today. We talked about this point figure chart a couple of weeks ago. This is why we've had no technology. This is the semiconductor index. Look at the relative strength cratering. Semiconductor index now down 39% off the highs. And we talked about this. Now, this is the extent of the tech bull market. We said many times along the way when the stocks got stretched way above the long-term moving average, the 200-week moving average, it corrected back into the moving average, and you got 40, 50% corrections. And so this was the battle that we had internally while NVIDIA continued to look good. And I said, look, it's unlikely that if the sector's selling off, NVIDIA, no matter how good it is, can hold up against it. it will get hit at some point, and we eventually moved aside. But I do find it interesting that we are now solidly below the 200-week moving average as of the close today. So unless that gets up very quickly, I think you have to question between the QQQ versus semiconductor chart, which shows a material structural change, and the semiconductor chart itself being below the 200-week moving average. I don't think this is a dip that you can buy in technology. I think it's very possible that we're entering a world where tech underperforms for an extended period of time. And it's a big part of the US market, right? Gold versus semis, a very clear shift that hasn't taken place since the early 2000s. This is one for Canadians, semis versus equally weighted large cap Canadian energy companies. Energy started to outperform in 2020. We went through a tightening cycle, and so tech outperformed for a bit, but energy now outperforming. Inflation versus disinflation. Another important sector for the US economy, the consumer, right? Consumer has broken the long-term moving average. This is the XLY, and it includes companies like Amazon and Tesla and Home Depot, McDonald's, Starbucks. It's very possible that if you have tariffs, the consumer gets squeezed. And I think that the US administration, I understand their goals, but I think they misunderstand the second and third derivatives of the things that they're doing and what kind of damage they can create. This is the Russell 2000 Growth Index. So the companies in the Russell 2000 that are growth stocks, this index is down 26, 28%. And today closed very close to these lows. So look, at some point there will be a ferocious bounce, I'm sure, in these things. From what level, I don't know. We don't buy bottoms. I find that the most important thing is not to let a little mistake turn into a big one. What's in motion tends to stay in motion. If something is headed lower, the more likely path is for it to continue to move lower. And when all of the growth-oriented indices we see are breaking down relative to the rest of the market, you got to be careful. This is the S&P Growth Index relative to the Value Index. Sorry, value relative to growth. I've got this mismarked. So value has underperformed substantially in 2020, had a bounce in 2021, had a bounce and reversed the trend. And then over the last while tech was rallying again, underperformed. But it looks to me as though value is taking the mantle here. And that's important because, the US is a growth stock market. Canada is more of a value market. Global stocks are more of a value market. The valuations are half what the US index is. And I just don't think that given the changes, 12 or 13 or 14% in the S&P is enough to offset some of the uncertainties that we've seen. And we're starting from a very high valuation. So as we talked about on the defensive assets, the utilities held up for a while, but we noted like it was never in an uptrend. And look at the last 3 days, really, it's taken it on the chin. So it comes down to positioning. We just have to be kind of patient. We're really well defended. We have about 24% cash, just cash, which will move into T-bills this week. We've got 16% T-bills and short-term bonds. So you can do the math on that. That's 40%. We've got another 8% in corporate bonds, 50%. If you look at our weightings, we got 12%. That's virtually all gold. That's a hedge against inflation and a hedge against, bad things that happen. Our energy weight, which is 11%, is about half pipelines and about half natural gas producers. They're selling into the liquefied natural gas market. Our industrial weights has come down. We took our financials weight down specifically because actually we started taking it down before the weakness hit. But if things get bad enough, they come for the leaders. So we just thought good idea to take our exposure down. And then when it comes to consumer communications, technology is almost a 0% weight. Really not much exposure here. So to summarize it, in our equity mandates, and we have different mandates, as you know, equity mandates would be about 55% cash and cash equivalents and 7% gold. So that's about 38% stocks. Income mandate is 45% cash and cash equivalents, 13% gold. The rest is dividend growth. The balance mandate, 25% cash and cash equivalents, 6% gold, miners, 5% physical gold, and 40% corporate bonds, short-dated corporate bonds. So, this is a very defensive stance. And look, this will pass, and we are going to have some tremendous opportunities. We're in a great spot. If things get worse, it's actually kind of good for us. And when leadership emerges, we can put money to work, and it's not going to be a race. Global Fund is continuing to hang in very, very well on a relative basis versus its benchmark since inception. A very solid outperformance. And this is without a positive night last night. Things we have to remember, we are in a liquidity cycle. Central banks around the world are likely to loosen, and so that will ultimately be supportive. When you get a loosening monetary policy, you do get price pressure. So, our being invested in inflation-oriented assets, I think, is the place to be, because ultimately that is likely what performs on the other side. And at the end of the day, pullbacks and corrections are normal, and positive returns come on the other side. When that's going to be, it could be near term, could be weeks or months out. We'll wait and see. In some ways, we are all hostage to the news flow, but generally we'll see things start to change internally in the market, before we get a lot of game-changing news. So we wait, right? We're in a long-term bull market in stocks. My guess is we are transitioning from a bull market in U.S. stocks to a bull market in global stocks, where they will outperform. It may just be that U.S. stocks underperform for a while. If we see breadth improve, we'll act on it. And if things get worse, we're pretty well defended now, but I suppose we could always get more defensive if need be. But we'll take this week by week and day by day. And with that, let's see if we got any questions. Annie, thank you for the Sunday update. Well, I'm glad you appreciated that. I thought it was a good idea to send something out. Anonymous, we're retired. We have a significant cash balance. Where would you put it in the short term while we wait to reinvest? Our suggestion is two places. I think that for the time being, short-term bonds and T-bills are a place to house money that will get reinvested. Long-term, cash is not a great place to be. And I would suggest probably everybody has some gold, because this is an asset that is well suited to the time that we're in. And if you don't want to own physical gold, you can own the PHYS ETF. That's the way we have done it. It's liquid and trades every day, but it's backed by physical gold. And I think that's all the questions we had. Okay, well, listen, I know this is no fun. We have been glued to our desks. I was supposed to be in Winnipeg on Monday, and I have very patient clients who agreed to postpone the meetings. I thought it was important for us all to be together as a team. And we'll take the information as it comes. I feel thankful that we have a process that lets us keep emotion out of the equation. And if you want to have a private conversation, please reach out. We've had a lot of nice new folks become clients over the last while, and I hope that they're happy with the job that we're doing. Thanks very much, guys, and we'll see you again next week.